Hello everyone, welcome to our discussion of chapter 4 in your textbook. And I thought we'd start out with this first podcast about chapter 4 with looking at the schedule 1 for the 1040, which shows some of the things that go into calculating AGI. So what do we mean by AGI? Adjusted gross income. So this is a you might say a subtotal, a preliminary calculation of income. You take your total income and then you subtract out some specified things. For instance, deductions for business expenses, for rental expenses we'll talk about in later chapters, in chapter 6 and chapter 8. But then there are some specific things that if you spent money on that you can deduct as for AGI. So what we mean by for AGI is that it is calculated and subtracted out to get the calculation of AGI. So why is that important? Well, AGI is the measure that is used for a lot of the phase-out situations in the tax law. So, for instance, you may get a deduction for something of, say $1,000, but it may phase out if your AGI is over a certain amount. So, if your AGI is too high, then that deduction would go away. So not only would you have more income, but you'd have less deductions as well. So a for AGI deduction, all right, is impacted by it impacts the taxable income in two ways. Okay, it is subtracted from AGI, and therefore our taxable income goes down, but it also may make it so that other amounts are also not deductible or are deductible depending on what the situation is. And so it might have a double impact. So for AGI deductions are particularly valuable, you might say, when talking about reducing our tax liability versus from AGI, which are deducted after we get AGI, which means they are not influenced by how much they do not impact AGI. So they don't have a double impact. They only just are subtracted for taxable income. And so therefore they don't have the extra impact of influencing other deductions. So you can see on this schedule some of the most common. I just want to point out a couple of things right here. Notice this one right here that is circled. It's on the tax return. These are the ones that are most common. We're not even going to get into all of these very rare situations down here on line 24, okay? We're only going to deal with some of these. Most of these we're going to talk about in chapter 4. But here's one that is not there. It used to be. And notice that it actually even has its own form and everything. Notice how specific it is. Certain business expenses of reservists. So if you're in the Army Reserves or National Guard, okay, performing artists, not exactly two groups that you think of as in the same breath, and fee basis government officials. So those three groups get a deduction for their business expenses. Nobody else does, okay, for AGI, all right? So those are very narrow, and that's why we don't deal with it, okay? So I just want to point that out because it sounds like it's a good thing, certain business expenses, and if you pull up Form 2106, it doesn't, it looks like we could use a lot of things for deductions, but it's limited to those small groups. And then we will talk about moving expenses, even though it has been limited now under change of the law to only members of the armed forces, as circled here. Okay, but we will go over that because that's a much bigger group. okay, than that, in terms of all those that are involved in the armed forces versus these small groups. And so it does come up fairly often. So that's how this is. All of these deductions then add up and then go to the 1040 where you calculate AGI. So first one we want to talk about, and this does not follow the order that it shows up on that Schedule 1, is student loan interest, okay? So first of all, it has to be for a loan to go to school, right? To pay qualified education expenses. It's got to be for a taxpayer, spouse, or dependent. Another situation where it's important to know if someone is a dependent or not. If they're not a dependent, then paying their student loan interest would not qualify under this deduction. It is limited to only $2,500. Doesn't matter how much you pay. If you pay $5,000 of student loan interest, only $2,500 maximum is deductible. So that's the first limitation besides what the loan is used for. Okay, and you can see that it's a little broader than just tuition and fees. You get books, supplies, equipment, room and board, all that kind of stuff. Okay, so it is a little bit broader, but it's not just living expenses, right? And it has to happen while you're a full-time student, okay? At least half the normal full-time load. That's basically the definition of the tax law of a full-time student is half the normal full-time workload, okay? And it can be graduate or undergraduate, doesn't matter, all right? So those are the things about the loan you need to make sure that you're doing it for. Now, this is our first discussion of a phase out. This is going to be reduced. Remember, it's already only $2,500, okay, maximum. But it's also reduced if your modified AGI is too large, okay, or too high. And modified AGI is just your AGI plus adding back any student loan interest. So before the loan interest deduction, and before income excluded out of the country, and for tuition and fees, and that starts to phase out at $145,000 on a joint return, okay, $70,000 on a single return. That gets totally eliminated when it reaches $175,000. So that's a $30,000 phase out range. So it starts to phase out if your income is you're only going to have a small phase out if your income is $145,100, but by the time if your income is over $175,000, this deduction, student loan interest, doesn't do any good. All right, if you're married filing jointly. All right, that seems like a lot, but the single is a little less than half that. And how do you figure out how much is disallowed? Okay, you take your preliminary deduction, so however much you paid up to $2,500. Okay, if you pay $3,000, then it's $2,500 is your preliminary deduction. Okay, and then you figure out the fraction. Okay, and you take that your modified AGI, you subtract the $145,000, see how far you're over the threshold, and divide it by 30,000. All right, and that is telling you the percentage that is disallowed. That's how much is not allowed. Okay, then the rest of it is allowed of the $2,500. Okay, so that's how student loan interest works, and that amount calculated then goes on that Schedule 1, assuming that is applicable to our situation. All right, the next one is a contribution to a health savings account. You'll also see some things about Archer savings accounts and MSAs and things like that. They are similar but have more restrictions that have gone away. Everything's been basically replaced by HSAs. However, people may still have some of those old plans and still be following some of those old rules. We're going to focus on what's more the newer rules here, the health savings account deductions, and they're more forgiving, you might say, than the old rules were, and allow for a bigger deduction. Okay, so a health savings account is basically, the idea is you put money into an account that you can use to pay costs for medical care, and if you do so and pay it for medical care, the money coming out of it is not taxable. Okay, it's used for qualified medical expenses, and again, it's got to be for you, your spouse, or your dependents, right? So, and if you qualify, if you have this, and it has to be set up the correct way, it has to have a trustee, all that kind of thing. It can't be just, oh, that account is for my medical savings. It has to be set up a specific way. Then you can deduct the amount you put into it as a 4 AGI deduction. All right. Now, not everybody can do this. To be eligible, you have to be self-employed, okay, or an employee of an employer with a high deductible health plan. So if you're self-employed, you have to buy that high deductible policy. Now, you have to have that. You can't have an HSA be the only coverage you have. You have to have this health coverage. And you can't have other types of health insurance, okay? So it has to be the only thing that is available, or the choice you've made at your employer, that sort of thing. It can't be, you can't have multiple plans. So otherwise you're going to be disallowed for this. So what does it mean by a high deductible plan? Okay, for 2022, the minimum deductible has to be $1,400. You can't have a deductible lower than that. Okay, and family coverage $2,800, and then there's a maximal deductible and out of pocket. Okay, for the year. What is your health savings account? So you have to go to an insurance company, or your employer has to go to an insurance company and choose a plan that fits this criteria. They have to say, we need something that fits the HDHP, the high deductible health plan, for health savings accounts purposes. Otherwise, you're not going to get that situation correct. Okay, and it will they will then make sure that these things are in place, and then this is how much you can put in total contributions for the year as well. Maximum deductible and out of pocket, the same number applies. So all this is reported on a form 8889 and put it on their 1040. Okay. So if you make it contributions, okay, and if you take money out, it's tax free. Now here's the thing that you need to remember. If this HSA is sponsored by your employer, okay, and the employer has the high deductible plan and provides coverage and pays for it, or you pay for it, whichever, then there are a couple different ways that money can get into your HSA. Your employer could put money into it. If that's the case, okay, it's going to not be income to you, but then you wouldn't be able to take a deduction for that amount on as a 4 AGI deduction, because it already is. It hasn't been counted in your income anywhere, so you can't have a deduction for it. If your employer allows you to have money taken out of your check to put in your HSA, that has already, it should be, if your employer does it right, should already be subtracted on your W-2 as well. All right, but this could come into play if your employer doesn't allow that. You just put money in by writing checks into the health savings account. Then you could do it that way. You could do that even if the employer puts in a certain amount and takes money out of your account. You can still go and put additional amounts in using just regular pay as long as you don't go over these maximums, right? These maximums you can put in, then that's allowed. And then you would have this for AGI. You just need to make sure that the amount that you put in the health saving account has not already been subtracted off of the W-2 when you're dealing with this in preparing a tax return. So who can hold this account? Typically, it needs to be a financial institution or bank, Moving HSA. Okay, these are the same folks that usually handle IRAs, MSAs, the old plans. Okay, and that sort of thing. As long as you use a reputable company that can show you that they are a health savings account administrator or custodian, you're good to go. It's not too hard to find them. All right. The third for AGI deduction is moving expenses, and notice that it's only for the military starting in 2018. Okay? It used to apply to everyone as long as they moved a certain distance. Okay? So here the restriction is they have to be on active duty and because of a permanent change of station. Okay? And notice that we're unreimbursed moving expenses. So anything that we pay to move ourselves that the military doesn't reimburse you for. Okay, so here's the definition of permanent change of station. They do not include, the service member does not include the income, the value of moving services provided by the government. Well, the government moves you, you don't have to pay anything out of pocket. That's not income to you. Okay, or any of the other temporary allowance, move-in housing allowance, those sort of thing. If you get reimbursed, the military says we'll reimburse you a flat amount, and it doesn't cost that much, then the additional amount goes on your W-2. Okay. So here's the things that count as moving expenses: storage of household goods, okay, getting everybody there, trucks, rentals, all that type of thing. However you need to travel, you could send part of the family by airplanes, part of the family could drive, okay, all of that on the way, okay. Lodging is deductible, included in moving expenses, but not meals. Okay, let's say you rent a truck, and one spouse drives the truck, and the other spouse drives a car. Okay, well you have you've got expenses for both. Now the truck is going to charge you per mile, and you're going to have that as a cost, and you'll have a bill. You'll put gas in that truck. That'll be on top of the per mile. You'll have that. Okay, but also the car, you can either keep track of your gas expenses and things like that, or you can use a standard mileage rate, which is 18 cents per mile. So all you have to do is figure out what the distance is between the 2 points that you're moving, and multiply by 18 cents in the first half of the year, 22 cents in the second half. You remember gas prices went through the roof in 2022, and so they actually changed the rate, which is supposed to be kind of an approximation of what the gas cost would be to go that. So you can do either the actual keep your receipts or figure out it using mileage. Okay, parking fees and tolls can be done that way. Okay, and it should be the straight shot. It should be if you go off to the side to see something or while on your way, that part of the trip is not deductible. Okay, and so different for foreign moves. They expand if it's a foreign move to moving and from storage and storing them for all the time they're on the new body release or names duty station. So that extra storage cost is available if it is a foreign move. All right, so some others in part 2.